We have continually made the point that the supply chain should be efficient. Although we have not explained explicitly what we mean by efficient, we have assumed that it means some combination of fast deliveries, low cost, high customer service, no waste, and so on. Now we should look at this in more detail and consider exactly what we mean by an efficient supply chain and how managers can make their logistics more efficient. We start by considering a question which asks how managers know that they are making progress, and the answer is that they measure performance and make sure that it is improving. This seems an obvious statement, but it is really quite complicated. The first point is an assumption that measuring performance serves a useful purpose. This seems reasonable as virtually every other aspect of management performance is measured, so there is no reason why logistics should be excluded. Without measures of performance, managers do not know how well they are meeting objectives, which areas need improvement, where limited funds should be invested, or how changes have affected operations. In the same way, they cannot compare current performance with historical performance, competitors, or other parts of the firm. So, measuring performance is an essential part of every function. However, we have to be careful here, as measures are not answers in themselves, but they only give one set of information that managers can use when they actually make their decisions. The next assumption is that there are appropriate measures of logistics performance. Again, there always seem to be things to measure, and with logistics there is actually a huge number of possible measures. The problem is not finding a measure but choosing the most appropriate from those available. This does not mean that every important factor can be measured, and many key issues are essentially qualitative. We conclude that managers should measure logistics performance, that measures are available, and they should choose the most appropriate. Let's start with some financial measures. Managerial measures of performance concern finances, such as the return on assets, payback period, or contribution to profits. The basic financial measure is profit, which is the difference between revenue and costs. This seems straightforward, but remember that any financial data depends on accounting conventions and does not necessarily give an objective view. Another problem is that absolute measures do not really say much. As a profit of $1 million, for example, would be wonderful for a small hairdresser salon, but a disaster for companies such as Apple or Microsoft. To get around this, financial measures are often reported as ratios, such as the profit margin, which is the profit before tax and interest as a percentage of sales, or return on assets, profit as a percentage of the organization's assets. This is arguably the most comprehensive measure of business performance. Asset test, the ratio of liquid assets and liabilities. Financial measures are popular as they are easy to find, sound convincing, give a broad view, and allow comparisons. But they also have weaknesses as they concentrate on past rather than current performance, are slow to respond to changes, rely on accounting conventions, and do not record important aspects of logistics. Financial performance can show that something is wrong, but it does not show what is wrong or how to correct it. Financial measures also assume that firms know their logistics costs reliably, but this is not always true. Accounting conventions describe costs in ways that are not aligned to logistics, so fixed costs, for instance, include a range of costs that are directly attributed to logistics and a range of others that are not, and the cost of logistics depends on the way that overheads and administrative charges are allocated. In principle, we use this formula for total cost of logistics, but the reality is that finding a total cost for logistics is far more difficult than it appears. Even when managers cannot find logistics costs exactly, they can often use surrogate measures. For instance, they can use a system of standard or nominal costs that should be incurred if everything is working normally. And if actual costs are higher than this, it means that something is going wrong and needs investigation. Reducing cost is a common theme for managers. They do not necessarily look for the lowest cost, but for a balance that best achieves their aims. The point is that logistics costs do not occur in isolation, and changes to the supply chain affect a broad set of functions. Imagine a company that decides to import materials from a distant supplier because it can negotiate a lower price. But if there is any problem with material, such as slightly more variation in quality, this cost is not picked up by logistics but by manufacturing, quality management, or customer service. So financial measures give useful information, but they should be viewed in conjunction with more specific measures of logistics. In the same way, we can use some other general measures, like capacity and utilization, but that should be viewed alongside specific measures of logistics. We define the capacity of a supply chain as the maximum amount that can move through it in a specified time. This is a basic measure of supply chain performance. Each part of a supply chain has a different capacity, and the overall capacity is set by the bottleneck. It might seem strange to describe capacity as a measure of performance rather than a fixed value or constraint on the throughput, but there are two answers to this. Firstly, we can say that the capacity depends on the way that resources are used. Two organizations can use identical resources in different ways and get different throughputs. Then the capacity gives a direct measure of performance and management skills. Secondly, we already pointed out that capacity is not fixed but varies over time. At the start of the day, a team of people might be able to move 500 cases an hour. At the end of the day, the same team are tired and can only move 400 cases an hour. The operations are exactly the same and have the same design capacity, but the effective capacity has declined. Remember that the designed capacity is the maximum possible throughput in ideal conditions. Effective capacity is what we can actually achieve over the long term, and actual throughput shows what we actually achieved. Utilization shows the proportion of designed capacity that is actually used. Suppose you have a vehicle fleet that is designed to deliver 100 tons of materials a week. This is the design capacity. If the fleet only delivers 60 tons in 1 week, then utilization is 60 divided by 100, or 60%. We know that the design capacity of a supply chain varies along its length, so it also has different utilizations. Then you might find that a transport fleet is underutilized while the warehouse it is delivering to is working flat out. This figure here illustrates some typical calculations for this. Here the capacity along part of a supply chain varies between 180 units and 700. And when the throughput is 140 units, the utilization varies between 20 and 78%. The bottleneck is the part with the smallest capacity, which is section D here. If managers want to increase throughput to more than 180 units, they will have to increase the capacity of this section. Productivity is one of the most widely used measures of performance. Unfortunately, people often confuse its meaning, assuming that it is the amount of work done by each person. There are really several kinds of productivity. The broadest picture comes from total productivity, which relates throughput of a supply chain to the amount of resources used. Unfortunately, this definition has a number of drawbacks. Throughput and resources must use consistent units, so they are normally translated into units of currency. Then the result depends on the accounting conventions used, and we no longer have an objective measure. Another problem is finding values for all the inputs and outputs. This is particularly difficult for intangible inputs, such as sunlight, the legal system, and outputs such as pollution, product image. Of course, we could say that we are only interested in the important factors, but then someone has to decide which these factors are, and we have again lost our objectivity. Because of these practical difficulties, virtually no one uses total productivity, preferring to use partial productivity or single-factor productivity. This measures the throughput of a supply chain to the amount of one resource used. The four most common types of partial productivity relate the throughput to four types of resources. First one is equipment productivity, such as the number of customer visits per van, pallets moved per forklift truck, or miles flown per airplane. Labor productivity, such as the number of deliveries per driver, tons moved per shift, or orders shipped per hour worked. Capital productivity, such as the amount stored for each dollar of investment, deliveries per unit of capital, or throughput per pound invested in equipment. Energy productivity, such as the number of deliveries per liter of fuel, amount stored per kilowatt hour of electricity, or the value added for each dollar spent on energy. Productivity is a very useful measure of performance, but if you hear someone talking about it, you have to look very carefully at what they mean. As well as the general measures we mentioned in previous lecture, there are many specific measures of logistics performance. Although we describe these as measures, some are clearly more difficult to quantify than others. We might say, for example, that 95% of orders were delivered on time, but it is much more difficult to measure customer satisfaction or the helpfulness of drivers. Nonetheless, these may all be important, so we can benefit by assigning numerical values. Sometimes we can use surrogate measures, perhaps measuring customer satisfaction by the number of complaints received. More often we use notional scales, typically asking customers to rate some factor on a scale of 1 to 5. But remember that when we use this method to judge customer satisfaction, staff morale, management leadership, or any other intangible concept, we're trying to give numerical values to essentially non-quantifiable factors and should treat the results with caution. Performance of warehouses. Warehouses operations have a different range of performance measures, often related to the rate of stock turnover or utilization of space. A basic measure is the throughput, which is generally taken as the value of items issued in some period. Many other measures are based on the value of stock held, but there is an obvious problem as this can vary quite widely over time. So these measures use an average or typical value for stock. Taking a single product, the average amount of stock is around halfway between the minimum and maximum levels. To find the average value of stock for the product, we multiply this average level by the unit value. Adding this for all products gives an average total inventory value. This is really a notional value as there is no point at which the average amount of every product is actually in store. The average stocks are estimates, as are the unit costs. Nonetheless, managers can track this value over time and look for trends, and if it rises steadily over time, there might be some cause of concern. More useful measures relate to the amount of stock to the demand. Then managers can measure the number of weeks supply held in stock. Ideally, this should be as low as possible, suggesting that stocks are kept to a minimum, but when supply or demand varies widely or is uncertain, then a manufacturers may hold, say, 10 weeks supply or more. On the other hand, companies using just-in-time operations might only hold a few hours supply. A slightly different view measures the stock turnover or turn. This shows how quickly materials move through the supply chain. If, for example, the annual throughput of a warehouse is 1 million and the average total inventory value is $200,000, the turnover is 5. This means that materials are replaced an average of 5 times a year and the average stock level is 1/5 years or 10 weeks supply. Other common measures of warehouse performance include average stock value, utilization of storage area and volume, order cycle time, time to prepare each shipment, errors in order picking, damage and loss, and so on. An obvious problem with so many diverse measures is that they give different and often conflicting views. When a truck is driven faster than usual, the miles per hour go up, but the miles per liter of fuel go down. When a shop is renovated, its sales per square meter go up, but its sales per pound invested go down. Increasing the amount of automation in a warehouse gives higher labor productivity but lower capital productivity. To get a reasonable picture of logistics, we have to take a balanced view of measures. This means that we have to decide which measures are important and the weight to give to each. For this, we have to remember that measuring performance is not an end in itself, but it gives information about how well a supply chain is achieving its goals. To give a reasonable view of logistics, a measure must relate to the objectives of the supply chain, focus on significant factors rather than unimportant ones, be measurable, be objective, look at current performance, not historical trends, allow comparisons over time and with other organizations, be easy to understand by everyone concerned, and be difficult to manipulate, avoiding false values. Comparing performance. Measures of performance are not an end in themselves, but they help logistics managers make decisions. In particular, they can be used to see how well objectives are being achieved. Compare the current performance of logistics with performance in the past. Make comparisons of logistics with other organizations. Compare the performance of different parts of the supply chain. Make decisions about investments and proposed changes. Measure the effects of changes to the supply chain, and highlight areas that need improving. You can see that several of these involve comparisons because absolute measures often have little real meaning. If you know that a shop has annual sales of $1.8 million, this does not really tell you much. It would be excellent for a local convenience store, but a disaster for a supermarket chain. But if you knew that the sales were $1,200 per square meter, this would be much more use as you could compare it with other shops, years and targets. There are 4 ways you can make such comparisons. Absolute standards, which give the best performance that can ever be achieved. This is an ideal performance that operations might aspire to, such as the target of 0 defects in quality. Target performance, which is a more realistic target that is agreed by managers who want to set tough but attainable goals. The absolute standard for the number of customer complaints received each week is 0, but a more realistic target might be 4. Historical standards, which give the performance that was actually achieved in the past. As managers are always looking for improvement, this is really the worst performance that they should accept. Competitor standard, which looks at the performance achieved by competitors. This is the lowest level of performance that an organization must achieve to remain competitive. Federal Express delivers packages absolutely positively overnight, so other delivery services must achieve this standard to compete. This is the basis of benchmarking. Some ways of making comparisons are very informal, such as warehouse managers visiting other companies and looking for ideas they can use. Benchmarking gives a more formal approach. It says that there is no point in comparing performance with some random competitor, so managers should look for the industry's best performance and get ideas from them. A standard 6-step procedure starts with managers recognizing the need to improve logistics. Then they define the most appropriate measures of performance, identify the leading competitor in the industry, and examine their logistics to see how they achieve this superior performance. The next step is to redesign their own supply chains and implement the results. To be blunt, managers use benchmarking to find ideas for logistics that they can copy or adapt. The easiest way to organize benchmarking is not to use a competitor, but for one division of a company to compare its operations with another division. Although this gives a limited view, it avoids the obvious problems with getting access to information, ensuring cooperation and commercial sensitivity. You might assume that a company with superior performance would be reluctant to give details of its operations to a competitor, but in practice it can be fairly easy to get the information. Of course, it is sometimes difficult to find or get information from a direct competitor, but managers can still get useful results from organizations in other industries. Sometimes firms can learn from completely different types of operations. in the way that train operators can find improvements from airlines or other companies that are not involved in transport but give high customer service, such as supermarkets. Scope and overview of the metrics. The model of supply chain operations metrics and KPIs I'm going to share describes the business activities associated with all phases of satisfying a customer's demand. The model itself contains several sections and is organized around the 5 primary management processes of plan, source, make, deliver, and return. By describing supply chains using these process building blocks, the model can be used to describe supply chains that are very simple or very complex, using a common set of definitions. As a result, disparate industries can be linked to describe the depth and breadth of virtually any supply chain. The model has been able to successfully describe and provide a basics for supply chain improvement for global projects as well as site-specific projects. It spans all customer interactions, order entry through paid invoice, all physical material transactions, supplier to customer, including equipment, supplies, spare parts, etc., and all market interactions, from the understanding of aggregate demand to the fulfillment of each order. It does not attempt to describe every business process or activity. Specifically, the model does not address sales and marketing, product development, research and development, and some elements of post-delivery customer support. We are going to explore the performance indicators and their metrics shown in this table. The 5 performance indicators are supply chain reliability, supply chain responsiveness, supply chain agility, supply chain costs, and supply chain asset management. And their strategic metrics: perfect order fulfillment cycle time, upside supply chain flexibility, upside and downside supply chain adaptability, supply chain management costs, cost of goods sold, cash-to-cash cycle time, return on supply chain fixed assets, and return on working capital. Each of these strategic metrics has its own operational metrics. The first performance indicator we're going to see is supply chain reliability. It is the supply chain performance in delivering the correct product to the correct place at the correct time in the correct condition and packaging in the correct quantity with the correct documentation to the correct customer. Its strategic metric is perfect order fulfillment. Perfect order fulfillment is the percentage of orders meeting delivery performance with complete and accurate documentation and no delivery damage. Components include all items and quantities on time using the customer's definition of on time, and documentation, packing slips, bills of lading, invoices, etc. Here is the calculation: total perfect orders divided by total number of orders multiplied by 100%. The perfect order fulfillment calculation is based on the performance of each operational metrics of the order line to be calculated: product and quantity, date and time and customer, documentation and condition. For an order line to be perfect, all of the individual metrics must be perfect. The performance of the supply chain is considered perfect if the original commitment made to a customer is met through the supply chain. An order is defined as a collection of one or more order lines representing a request to deliver specified quantities of goods or to render specific services. The order can further be defined as a request with a specific identifier as a reference to deliver specified items or to render specific services with specific prices, dates, and quantities. Commitments are made to a customer at the order line level, where an order line is defined as a line representing a commitment on a sales order. For an order to be considered perfect, the following standards must be met: delivered complete, All items on the order line are delivered in the quantities specified. Delivered on time to the initial commitment date using the customer's definition of on-time delivery. Documentation supporting the order, including packing slips, bills of lading, invoices, quality certifications, etc., is complete and accurate. Faultlessly installed as applicable, correct configuration, customer ready and accepted, no damage on specification. Orders cancelled by the customer are excluded from the metric. Order changes initiated by the customer and agreed to by the supplier supersede initial commitments and form a new comparative basis for the metric. The term customer ready for the perfect condition standard may imply a subjective component based on the customer's satisfaction. Although condition may not be as rigorously measured as time or quantity, it should be considered as a component if available, especially since this attribute measures performance of the supply chain, which is of course ultimately measured by its customer. The operational metrics for perfect order fulfillment are orders delivered in full, delivery performance, documentation accuracy, and perfect condition. The second performance indicator is supply chain responsiveness. It is defined by the speed at which a supply chain delivers products and services to the customer. A strategic metric is order fulfillment cycle time. This is the average actual cycle time consistently achieved to fulfill customer orders. For each individual order, this cycle time starts from the order receipt and ends with customer acceptance of the order. The calculation is order fulfillment cycle time equals source cycle time plus make cycle time plus deliver cycle time. The order fulfillment cycle time, as captured from the moment a customer places the order to the moment the order is fulfilled, is considered to be a gross cycle time. It represents all the time passed between these two events, regardless of whether this represented cycle time for the activities performed by the organization to fulfill the order, both value-added and non-value-added, or dwell time because the order was placed well in advance by the customer. As such, this gross order fulfillment cycle time does not truly reflect the responsiveness of the organization. Take for example an organization that needs 6 days to fulfill a certain customer order. If the customer places the order 1 day in advance, the gross order fulfillment cycle time will be 7 days. If the customer places the order 3 months ahead, pre-ordering, the gross fulfillment cycle time will be 96 days. However, the fact that the customer pre-orders does not reduce the responsiveness of the organization. On the contrary, one can argue that it may increase the ability of the organization to meet that order, as it allows the organization to plan ahead and fulfill the order in a more optimal way. The responsiveness of the organization is determined by the cumulative cycle time for all activities that are required to fulfill the order, but should exclude any dwell time where no activity takes place. There are 3 operational metrics that describe order fulfillment cycle time: source cycle time, make cycle time, and deliver cycle time. The next strategic performance indicator is supply chain agility. The agility of a supply chain in responding to marketplace changes to gain or maintain competitive advantage. It has 3 strategic metrics: upside supply chain flexibility, upside supply chain adaptability, and downside supply chain adaptability. In this lecture, we will see the upside supply chain flexibility, which is the number of days required to achieve an unplanned sustainable 20% increase in quantities delivered. 20% is a number provided for benchmarking purposes. For some industries and some organizations, 20% may be in some cases unobtainable or in others too conservative. The calculation is the total elapsed days between the occurrence of the unplanned event and the achievement of sustained planned source make, deliver, and return performance. Elapsed days are not necessarily the sum of days required for all activities, as some may occur simultaneously. The calculation of supply chain flexibility requires the calculation to be the least time required to achieve the unplanned sustainable increase when considering source, make, and deliver components. For example, if it requires 90 days to achieve a 20% increase in raw material volume, 60 days for adding capital to support production, and no time to increase the ability to deliver, upside supply chain flexibility would be 90 days. If production changes can run concurrently with material acquisition activities, or as much as 150 days if production changes and material acquisition changes must run sequentially. Upside supply chain flexibility has 5 operational metrics. The first is upside source flexibility. This is the number of days required to achieve an unplanned sustainable 20% increase in quantity of raw materials. Next, upside make flexibility. The number of days required to achieve an unplanned sustainable 20% increase in production, with the assumption of no raw material constraints. Upside delivery flexibility. The number of days required to achieve an unplanned sustainable 20% increase in quantity delivered with the assumption of no other constraints. Upside source return flexibility. The number of days required to achieve an unplanned sustainable 20% increase in the return of raw materials to suppliers. And last one, upside delivery return flexibility. This is the number of days required to achieve an unplanned sustainable 20% increase in the return of finished goods from customers. Certainly, enterprises deal with change all the time. In most cases, these changes are minor deviations from the norm or fleeting blips in the marketplace. Also, certainly most supply chains move through these changes almost effortlessly and in this regard demonstrate equivalent flexibility. In many extreme cases, however, it is possible that a particular supply chain has reached a condition of relative rigidity, say, at capacity or rigid, constraining agreements with partners, and a seemingly minor increase in production requirements can consume much time and effort as the supply chain struggles to restore its capability to perform. It is evidenced that enterprises engaged in appropriate business risk and competitive contingency planning activities will usually be in a better position to optimize overall supply chain performance, and these activities are presented as best practices later in the course. When change is known in advance, such as the biggest retailers requiring RFID devices on all delivered cases, or a major sourcing change is planned to occur, and is incorporated in the enterprise's operating plan, then the time incurred to undertake the adaptation isn't necessarily a reflection of the supply chain's flexibility. While flexibility is still addressed, it is frequently clouded by other considerations in the operating plan. Unplanned change is the primary consideration in measuring the supply chain's flexibility. The second strategic metric of supply chain agility is upside supply chain adaptability. This is the maximum sustainable percentage increase in quantity delivered that can be achieved in 30 days. Note that 30 days is an arbitrary number provided for benchmarking purposes. For some industries and organizations, 30 days may be in some cases unobtainable or in others too conservative. Upside supply chain adaptability has 5 operational metrics. First one is upside source adaptability, the maximum sustainable percentage increase in raw material quantities that can be acquired or received in 30 days. Upside make adaptability, the maximum sustainable percentage increase in production that can be achieved in 30 days with the assumption of no raw material constraints. Upside deliver adaptability, the maximum sustainable percentage increase in quantities delivered that can be achieved in 30 days with the assumption of unconstrained finished good availability. Upside source return adaptability, the maximum sustainable percentage increase in returns of raw materials to suppliers that can be achieved in 30 days with the assumption of unconstrained finished goods availability. And the last one, upside deliver return adaptability. This is the maximum sustainable percentage increase in returns of finished goods from customers that can be achieved in 30 days. The calculation of supply chain adaptability requires the calculation to be the least quantity sustainable when considering source, make, deliver, and return components. Adaptability measures are assumption-based or based on historical events. Some elements can be measured and taken as a basis for further considerations. Adaptability measures are based on the actual number of returns compared to the maximum number of returns which can be achieved within 30 days. The weakest component determines the overall volume. The third and last strategic metric for supply chain agility is downside supply chain adaptability. This is the reduction in quantities ordered sustainable at 30 days prior to delivery with no inventory or cost penalties. Here note also that 30 days is an arbitrary number provided for benchmarking purposes. Downside supply chain adaptability has three operational metrics. Downside source adaptability, the raw material quantity reduction sustainable at 30 days prior to delivery with no inventory or cost penalties. Downside make adaptability, the production reduction sustainable at 30 days prior to delivery with no inventory or cost penalties. And downside deliver adaptability, the reduction in delivered quantities sustainable at 30 days prior to delivery with no inventory or cost penalties. The calculation of downside supply chain adaptability requires the calculation to be based on the least reduction sustainable when considering source, make, and deliver components. Adaptability measures are assumption based on historical events. Some elements can be measured and taken as a basis for further considerations. The next performance indicator is supply chain costs. This is cost associated with supply chain operations. It has two strategic metrics, supply chain management costs and cost of goods sold. The total supply chain management costs is the sum of the costs associated with the processes to plan, source, deliver, and return. Note that the cost of raw material and make costs are generally accounted for in cost of goods sold. It is recognized that there is likely to be overlap or redundancy between supply chain management costs and cost of goods sold. The calculation for total supply chain management costs is sales minus profits minus cost to serve. Resource expenses such as salaries, supplies, etc. are initially captured in the organization's general ledger accounting system. Then these expenses are traced and assigned or distributed to the organization's horizontal core processes based employee time and non-wage related factors. Data for these expense distribution assignments are collected from employee time collection systems and operational systems. Collecting transactional information, primarily resource expenses and operational drivers, is now commonplace. The challenging task is to logically transform these expenses into calculated costs of the horizontal processes based on cause and effect relationships without the temptation of using broad averages or arbitrary factors. Total supply chain management costs has several operational metrics. These are cost to plan, cost to source, cost to make, cost to deliver, cost to return, and mitigation costs. A strategic metric for supply chain costs are costs of goods sold. The costs associated with buying raw materials and production finished goods. This cost includes direct costs, labor, materials, and indirect costs, overhead. The calculation for cost of goods sold is direct material costs plus direct labor costs plus indirect costs related to making products. Collecting transactional information, primarily resource expenses and operational drivers, is now a commonplace. The challenging task is to logically transform these expenses into calculated costs of the horizontal processes based on cost and effect relationships without the temptation of using broad averages or arbitrary factors. Other operational metrics for supply chain management costs are supply chain value at risk and mitigation cost. Value at risk is the sum of the probability of risk events times the monetary impact of the events for all the supply chain functions: plan, source, make, deliver, and return. Supply chain value at risk equals sum of supply chain value at risk in dollars for the processes of plan, source, make, deliver, and return. The value at risk calculation uses historical data on the specific event, on-time delivery, quality disruptions, failures, etc., to calculate the number of times the event performed below the target, or the probability times the amount below the target. For disruptions, value at risk would use estimated frequency based upon expert resources times the impact of the events. Supply chain value at risk can be used in the supply chain to evaluate the different aspects of risk. Suppliers can be evaluated based upon the value at risk of performance measures. Customers can also be measured based upon performance measures, such as profitability, volume growth, returns and complaints, as well as products, warranty claims, etc. Value at risk can also be applied to internal supply chain entities, such as manufacturing, distribution, or sales locations. Since value at risk can be monetized by accessing the cost of performance below target, value at risk can be rolled up and examined by any demographic or data cut, by region, by customer, by supplier, etc. Suppliers can be evaluated based upon value at risk and ranked according to the risk of poor performance. Here are some caveats in using value at risk. Value at risk calculates the probability of non-adherence to metrics value, expected value, based on historical data. Hence, it is a retrospective view of the event risk. The same may or may not be applicable in the future. Value at risk is a downside risk matrix. It calculates a maximum loss for each level of confidence or probability. In a real-life scenario, it is likely that the losses would be less than calculated using value at risk. Calculating value at risk from historical data requires a large database of events and metrics, and it could be computationally intensive. Supply chain risk mitigation cost. This is the sum of the costs associated with supply chain risk mitigation costs. Mitigation costs are the costs to mitigate supply chain risk, and they include sum of supply chain risk mitigation costs for all the processes: plan, source, make, deliver, and return. Mitigation costs, the total supply chain risk mitigation cost of all mitigation actions for a specific area, supplier, product, etc. in dollars. The last performance indicator used in the model is supply chain asset management. This is the effectiveness and efficiency of an organization in managing assets to satisfy customer demand. It has three strategic metrics: cash-to-cash cycle time, return on supply chain fixed assets, return on working capital. Cash-to-cash cycle time is the time it takes for an investment made to flow back into a company after it has been spent for raw materials. For services, this represents the time from the point where a company pays for the resources consumed in the performance of a service to the time that the company received payment from the customer for those services. The longer the cash-to-cash cycle, the more current assets needed relative to current liabilities, since it takes longer to convert inventories and receivables into cash. In other words, the longer the cash-to-cash cycle, the more net working capital required. The cash-to-cash cycle time is measured by converting into days the supply of inventory in stock and the number of days outstanding for accounts receivable and accounts payable. The inventory days of supply is added to the days outstanding for accounts receivable. The accounts payable days outstanding is subtracted from this total to determine the cash-to-cash cycle time. Here is the formula. Cash-to-cash cycle time equals inventory days of supply plus days sales outstanding minus days payable outstanding. Unlike other metrics where data requirements are specified, typically all of the cash-to-cash cycle time source data is already captured by business operating systems, such as General Ledger System, Accounts Receivable System, Accounts Payable System, Purchasing System, Production Reporting System, and Customer Relationship Management System. As a result, information is calculated by importing data from these systems and transforming them into the prescribed analytics and information. The transformation is accomplished using business rules. Cash-to-cash cycle time has three operational metrics. First one, inventory days of supply. This is the amount of inventory or stock expressed in days of sales. The 5-point rolling average of gross value of inventory at standard cost is divided by annual cost of goods sold divided by 365. Here is the example. If 2 items a day are sold and 20 items are held in inventory, this represents 10 days, 20 divided by 2 sales in inventory. Days sales outstanding. This is the length of time from when a sale is made until cash for it is received from customers. The amount of sales outstanding is expressed in days. It is the 5-point rolling average of gross accounts receivable divided by total gross annual sales divided by 365. The example, if $5,000 worth of sales were made per day and $50,000 worth of sales were outstanding, this would represent 10 days of sales outstanding, 50,000 divided by 5,000. Days payable outstanding. This is the length of time from purchasing materials, labor, and conversion resources until cash payments must be made expressed in days. This is the 5-point rolling average of gross accounts payable divided by total gross annual material purchases divided by 365. The 5-point rolling average calculation uses a combination of both historical and forward-looking data. This means that the rolling average value has to be calculated based on the average over the 4 previous quarters and the projection for the current or next quarter. The 5-point rolling average calculation is sum of the 4 previous quarters plus projection for next quarter divided by 5. The next strategic metric for supply chain asset management is return on supply chain fixed assets. This measures the return an organization receives on its invested capital in supply chain fixed assets. This includes the fixed assets used in plan, source, make, deliver, and return processes. The return on supply chain fixed assets is measured by monetizing the supply chain revenue, cost of goods sold, and supply chain management costs to determine the profit from the respective supply chain. This amount is divided by the supply chain fixed assets to determine the return generated from the respective supply chain. Here is the calculation. Return on supply chain fixed assets, supply chain revenue minus cost of goods sold minus supply chain management costs, and this divided by supply chain fixed assets. Supply chain revenue is used in the metric rather than just net revenue. Supply chain revenue is calculated as supply chain revenue minus cost of goods sold minus total supply chain management costs. This provides the revenue generated through the supply chain less the total costs associated with the supply chain. Net revenue could include revenue from sources other than the supply chain, such as investments, leasing real estate, court settlements, etc. Supply chain revenue will be used and will be only the portion of net revenue that is generated by the specific supply chain being measured and analyzed. Here are the operational metrics for return on supply chain assets. Supply chain revenue, operating revenue generated from a supply chain. This does not include non-operating revenue, such as leasing real estate investments, court settlement, sales of office buildings, etc. Cost of goods sold and total supply chain management costs are explored and calculated in the previous section. Supply chain fixed assets. These include source fixed assets value, make fixed assets value, deliver fixed asset value, return fixed asset value, and plan fixed asset value. The third and last strategic metric for supply chain asset management is return on working capital. This is a measurement which assesses the magnitude of investment relative to a company's working capital position versus the revenue generated from a supply chain. Components include accounts receivable, accounts payable, inventory, supply chain revenue, cost of goods sold, and supply chain management costs. The formula is supply chain revenue minus cost of goods sold minus supply chain management costs divided by inventory plus accounts receivable minus accounts payable. The return on working capital is measured by monetizing the supply chain profit and dividing into the calculated amount the supply chain working capital position. Here are the operational metrics for return on working capital. Supply chain revenue, operating revenue generated from a supply chain. This does not include non-operating revenue, such as leasing real estate investments, court settlements, etc. Cost of goods sold and total supply chain management costs are explored and calculated in the previous section. Inventory. This is the amount of inventory expressed in dollars, the 5-point rolling average of gross value of inventory at standard cost. Sales outstanding. This is the amount of accounts receivable outstanding expressed in dollars, the 5-point rolling average of gross accounts receivable. Payables outstanding. Expressed in dollars, the amount of purchased materials, labor, and conversion resources that are to be paid, accounts payable, the 5-point rolling average of gross accounts payable. The 5-point rolling average calculation uses a combination of both historical and forward-looking data. This means that the rolling average value has to be calculated based on the average over the 4 previous quarters and the projection for the current or next quarter. Supply chain risk basics.